Hello, friends. We are officially into July now, and this month is bringing real changes that affect millions of homeowners over 60 across the country. Not next year, not eventually, right now, this month, while most people are focused on summer plans and not on the paperwork sitting quietly in their mailbox. I want to walk you through 5 developments that are actively unfolding in July 2026. Some of them can save you thousands of dollars if you act before a deadline closes. Others involve deadlines that have already opened and are moving fast. And one involves a ballot measure that could reshape property taxes for seniors entirely if it reaches the finish line. Before we get into it, subscribe right now and turn on the notification bell. These deadlines do not wait for anyone, and I want you to hear about them here before they show up as a surprise in your mailbox. Let's get into it. Number 5. Texas just tripled the senior property tax exemption. Let's start in Texas because this is one of the largest senior property tax relief packages any state has passed in recent memory, and it is fully in effect for the 2026 tax year right now. For years, Texas homeowners age 65 and older received an additional $10,000 exemption on top of the standard homestead exemption. That $10,000 figure had not moved in a long time, even as home values in Texas climbed. This year, that changed dramatically. Senate Bill 23 raised the additional senior exemption from $10,000 to $60,000. Combined with the standard homestead exemption increase to $140,000, a senior homeowner in Texas can now exempt up to $200,000 of their home's value from school district property taxes. Here's what that means in real numbers. If you own a $400,000 home in Texas and you are 65 or older, you are now paying school taxes on just $200,000 of that value instead of the full amount. At a typical school tax rate, that is real, meaningful savings landing on your bill this year, not a future promise. Action step. If you are a Texas homeowner 65 or older and have not filed for the senior exemption, or if your county has not automatically applied the new amount, contact your county appraisal district now using Texas Comptroller Form 50-114. And remember, once you qualify for the senior exemption, your school district taxes are frozen at that year's amount going forward. Your school taxes will not increase again even if your home's value keeps rising. That is one of the most powerful protections available to any homeowner in the country, and too many eligible seniors still have not claimed it. There is a second layer worth understanding here too. Texas allows retroactive exemption applications for up to 2 years if you qualified previously but never filed. That means if you turned 65 last year or the year before and never submitted the paperwork, you may be able to recover exemption savings you already missed, not just claim the exemption going forward. This is not automatic. You have to file the retroactive request yourself, and the appraisal district will not reach out to remind you that you left money unclaimed. If your appraisal district has a walk-in office, bringing a copy of your ID and proof of age in person can often resolve the filing in a single visit rather than waiting on mailed correspondence. Number 4. New Jersey is consolidating 3 relief programs and the clock is ticking. If you are a homeowner in New Jersey, pay close attention here, because the state has fundamentally changed how senior property tax relief works, and the changes are actively rolling out this year. New Jersey has historically run separate programs: the Senior Freeze, which reimburses seniors for property tax increases above a locked base year, and Anchor, a broader property tax relief rebate. This year, the state added Stay NJ, a new program that cuts the total current year property tax burden for seniors by up to 50%. As of 2026, all 3 are being filed through a single consolidated application, Form PAS1 for seniors 65 and older or those receiving Social Security or Railroad retirement benefits. Here's the part that catches people off guard. These programs interact with each other. Stay NJ reduces your bill by half, but that benefit is reduced by any senior freeze amount you already receive in the same year. Many homeowners assume they simply get everything stacked on top of everything else, and that is not how it works. Understanding the interaction between these programs before you file can meaningfully change what actually lands in your pocket. Action step. If you are 65 or older in New Jersey, file the consolidated form PAS1 through the Division of Taxation. Confirmation letters are going out this summer, and payments under this consolidated system begin rolling out in mid-September. If you do not receive a confirmation letter by late summer, do not assume you are automatically enrolled. Call the Division of Taxation and confirm your status directly. A missed form is the single most common reason eligible seniors leave this money unclaimed. It also matters which version of the form applies to you. First-time Senior Freeze applicants and long-time filers who have never used the consolidated system file the PAS-1 as their initial application, which establishes your base year property tax amount. That base year is the number everything else gets measured against going forward, so getting it filed correctly the first time matters more than people realize. If you have an income near the eligibility ceiling, keep your documentation organized. Eligibility is verified annually, and a small change in reported income from one year to the next can shift whether you qualify for the full benefit or a reduced one. Number 3, your property tax appeal window may already be open, and it closes fast. This is the one that affects homeowners in nearly every state, and it is the one most people do not think about until it is too late. Property tax appeal windows are short and they are not forgiving. In Colorado, for example, homeowners who want to protest their 2026 assessment have until June 30th to file with the county assessor. If that is denied, there is a second window to appeal to the County Board of Equalization between July 1st and August 5th. Miss both, and you are locked into that assessed value for the year, no matter how far off it is from what your home is actually worth. This pattern repeats across the country with different dates and different names, but the same underlying risk. Assessors use broad market data to set your property's value, and that data does not always reflect the specific condition or comparable sales for your individual home. If a similar home on your street sold for less than what the assessor says your home is worth, you have real grounds for an appeal, and the filing fee is typically minimal compared to what you could save. Action step: call your county assessor's office this week and ask 2 direct questions. First, has my property been reassessed for 2026, and what is the new value? Second, what is my appeal deadline, and has it already opened? Do not wait for the appeal window to be mentioned in your tax bill. Many counties expect you to know your own deadline, and they will not extend it for you after the fact. When you do file an appeal, the strongest evidence is almost always the simplest. Pull the recent sale prices of 2 or 3 homes on your street or in your immediate neighborhood that are similar in size, age, and condition to yours. If those homes sold for meaningfully less than what your assessor says your home is worth, print those comparable sales and bring them to the hearing. You do not need an attorney or a formal appraisal to make this case in most counties. An informal meeting with the assessor's office before the formal hearing can sometimes resolve the disagreement without you ever needing to appear before a board at all. Number 2. If you have a reverse mortgage, know these 3 requirements cold. If you or a family member has a home equity conversion mortgage, the federally insured reverse mortgage program run through HUD and the FHA, there are 3 ongoing obligations that determine whether that loan stays in good standing. These are not new rules invented this year, but HUD has been reinforcing lender compliance with occupancy verification procedures in 2026, and that makes this a good moment for every reverse mortgage holder to double-check where they stand. The first requirement is occupancy. The home must remain your primary residence, and you certify that annually. If a borrower is away from the property for an extended stay in a rehabilitation facility, skilled nursing facility, or hospital, occupancy status can become a real question, and it is worth understanding your lender's specific timeline rules before an absence stretches on. The second requirement is property condition. Reverse mortgage borrowers are required to maintain the home so it does not lose significant value through neglect. If maintenance has been deferred because of cost, that is worth addressing proactively rather than waiting for a lender inspection to flag it. The third requirement is staying current on property taxes and homeowners insurance. This is the one that causes the most defaults, and it is entirely preventable. A lapse in either one is treated as a default event on the loan, in the same category as failing to make a payment on a traditional mortgage. Action step: if you have a reverse mortgage, pull out your loan documents this month and confirm you are current on taxes and insurance, and that your most recent occupancy certification is on file. If you have a family member with a reverse mortgage who has been away from the home for medical reasons, call the loan servicer now, proactively, before any question arises. Waiting for a formal notice always shortens your options. Reaching out first always expands them. It also helps to understand how servicers actually verify occupancy when they cannot reach a borrower directly. Federal housing guidance requires mortgage servicers to determine occupancy status by a set point in the delinquency timeline, and when a borrower cannot be reached by that point, an in-person inspection is ordered. That means the fastest way to avoid any misunderstanding is simply staying reachable. If you have moved, changed your phone number, or designated a family member to help manage your affairs, make sure your servicer has that current contact information on file. A missed phone call is a far more common trigger for confusion than any genuine occupancy dispute. Number 1. California Seniors. A ballot measure to eliminate your property tax entirely is gathering signatures right now. This is the biggest potential development on this entire list, and it is moving through the process as we speak. A California ballot initiative, formerly titled the Measure to Exempt Certain Homeowners Age 60 or Older from Property Taxes, cleared the Attorney General's title and summary process earlier this year and is now in active signature collection. If it gathers roughly 874,000 valid signatures from registered voters by early August, it qualifies for the November 2026 ballot. If it reaches the ballot and voters approve it, homeowners 60 and older who occupy their home as a primary residence would be exempt from paying property taxes on that residence entirely, a change layered on top of the existing Proposition 13 protections that already cap annual assessment increases at 2% for continuing owners. To be clear, this is a proposed measure, not current law. It still needs to clear signature verification and then win a statewide vote in November. But for a state where property tax bills of $18,000 or more are not unusual in high-cost counties, this is a development worth tracking closely if you are a California homeowner 60 or older, because the outcome could materially change your finances in 2027 and beyond. Action step. If you are a California homeowner 60 or older, follow the progress of this measure between now and the November ballot. In the meantime, do not overlook programs already available to you today. If your home's market value has dropped below its assessed value, you can request a temporary reduction under existing law, and property tax postponement is already available for qualifying seniors 62 and older with income below the program threshold, meaning you can defer payment of your property taxes, with the deferred amount becoming a lien repaid when the home is eventually sold. It is also worth understanding how this measure would interact with existing law if it passes. California already limits annual assessment increases to 2% for continuing owners under Proposition 13, and reassessment currently happens primarily when a home changes ownership. A full exemption for homeowners 60 and older would sit on top of that existing framework rather than replace it, which is part of why the fiscal impact and the political debate around this measure are significant. Supporters argue it protects asset-rich, income-constrained seniors from being taxed out of homes they have owned for decades. Opponents point to the reduction in local property tax revenue that funds schools and services. Whichever side of that debate you land on, the practical step for a California senior right now is simply to stay informed as signature verification proceeds toward the November ballot. One more thing, watch your insurance renewal alongside your property tax bill. Before we wrap up, one development that touches every state I have mentioned and several more. Homeowners insurance premiums have climbed sharply over the past 2 years in states with heavy weather exposure, including Florida, California, Louisiana, Texas, Colorado, and parts of the Carolinas. If you are a reverse mortgage holder, a lapse in coverage because a renewal premium became unaffordable is treated exactly the same as a missed tax payment, a default event on the loan. If your insurer has sent a non-renewal notice or a steep premium increase, contact your state's Department of Insurance and ask specifically about insurer of last resort programs or state-backed coverage options. Do not let a policy lapse simply because the renewal number was a shock. There is almost always an alternative path, but it requires you to ask before the coverage gap opens, not after. Timing matters here too. Renewal notices typically arrive 60 to 90 days before your policy expires, which means the moment you see a steep increase or a non-renewal is exactly the moment to start shopping alternatives, not a week before the old policy lapses. If you are on a fixed income and a new premium simply does not fit your budget, ask your current insurer directly whether adjusting your deductible or removing optional coverage riders can bring the cost back into range before you assume you have to switch carriers entirely. Bringing it all together. Here is everything on one list. Texas seniors now have a $60,000 exemption on top of the $140,000 homestead exemption, and it is already in effect. New Jersey seniors need to file the new consolidated form PAS1 to access Stay NJ, Senior Freeze, and Anchor together, with payments beginning in September. Property tax appeal windows are open right now in multiple states, and missing one locks you into an assessment for the full year. Reverse mortgage holders need to confirm occupancy, maintenance, and tax and insurance compliance proactively, not reactively. California seniors should track a ballot measure that could eliminate property taxes for homeowners 60 and older while using the relief programs already on the books today. And anyone in a high-risk insurance state should review their renewal now before a lapse becomes a default. None of this is designed to alarm you without giving you something to do about it. Every single item on this list has a specific action attached to it, and in several cases, real money attached to taking that action before the relevant deadline closes. A note on sourcing. The developments covered here reflect publicly available state legislation, county assessor guidance, and federal housing program requirements current as of July 2026. Program details, deadlines, and eligibility thresholds vary by county and can change, so confirm the specifics for your situation directly with your county assessor's office, your state's Department of Revenue, or your loan servicer. If this helped you, share it with a senior homeowner in your life who needs to hear it. And subscribe, because the next round of changes is already on its way, and I want you to hear about it here first, before it shows up as a notice in your mailbox.